In 2018, tariffs took the Federal Reserve's inflation gauge from 1.9 to 2%. Tariffs were transitory.
It can be the case that it's appropriate sometimes to look through inflation if it's transitory, and that can be the case in the case of tariff inflation.
The market will be focused on this data point March 28th, hoping for more disinflation. We also have GDP Thursday and the health of the consumer, but more importantly, the market wants to see a flexible Trump.
I gave the American car companies a break because it would have been unfair if I didn't. And everybody said, oh, he changed his mind on tariffs. I didn't change my mind. I helped our sort of big three, big four.
On Friday, Trump triggered the market to close high of day. Call it hopium, but any chance of reciprocal tariff reductions would rapidly ease tensions while markets are in oversold conditions.
It's reciprocal. I don't change, but the word flexibility is an important word. Sometimes there's flexibility, so there'll be flexibility, but...
With a flexible Trump, a dovish Fed, and consecutive good inflation reports, the market is starting the bottoming process.
We do see pretty solid hard data still. So growth looks like it's maybe moderating a bit, consumer spending moderating a bit, but still at a solid pace. Unemployment's 4.1%. Job creation most recently has been at a healthy level.
On Thursday, the Fed delivered a dovish pause. As soon as the FOM statement hit the tape, the market ripped 1.5% in the next 60 minutes, and the VIX closed below 20 for the first time since February. When the VIX closes below 20 following a significant spike, that tells us the market is downgrading the level of fear. And now risk assets are starting to move higher. High beta, cyclicals, crypto, microcaps, and the IPO index. However, market breadth is still very poor. The number of stocks making new highs or trading above their averages is trash. So no signs of a sustainable rebound, but the dovish Fed may have put in a short-term bottom.
The economy is strong overall and has made significant progress toward our goals over the past 2 years. Labor market conditions are solid, and inflation has moved closer to our 2% longer run goal.
In the press conference, Powell pretty much crushed the notion that the U.S. economy was headed for recession. Sentiment data is useful. It can lead, but it can also be easily distorted. Right now, consumer sentiment is so political. We have Democrats expecting inflation to go to 6.5%, while Republicans are basically expecting inflation to go to 0. Both are very exaggerated and can't be trusted. Now we know the economy is slowing, but the service economy continues to expand. Industrial production, the hard data, is still beating expectations. Now, although Powell refused to project the next rate cut, he did provide reassurance and optimism by referring to tariffs as transitory and walking through if-then scenarios that would trigger rate cuts.
If the labor market were to weaken unexpectedly or inflation were to fall more quickly than anticipated, we can ease policy accordingly.
However, talk is cheap, the market wants action, and that's exactly what the Fed is now starting to deliver.
At today's meeting, we also decided to slow the pace of decline in our balance sheet. We have seen some signs of increased tightness in money markets.
Starting in April, the Fed will unofficially end QT by slowing the balance sheet runoff from negative $25 billion a month to negative $5 billion a month. This is a significant easing of financial conditions as it results in a surplus of cash reserves in the banking sector. Now, this was a total surprise. The Fed might not be cutting rates, but they are closer to ending QT.
But at a certain point, we'll stop runoff.
Now, when we add together selling pressure being completely exhausted with these other variables, I think we get the market putting in a short-term bottom. Tariffs are transitory, QT is over, the Fed has your back. TGA is adding liquidity to the banking sector, global money supply momentum is growing, and Trump may just reduce some reciprocal tariffs. As a reminder, markets bottomed the day after the 2018 tariffs were implemented. In 1962, markets bottomed during the Cuban Missile Crisis. So I think it's safe to expect the lows are in and the market is ready for a tactical rally going into the April 2nd tariffs if they actually happen.
The word flexibility is an important word.